When it comes to your credit score, it is probably one of the absolute vital things when it comes to finance. It is going to be impacted by your debt repayment. It is also going to be impacted by your payment history. Now in this video, guys, we are going to have a compilation of everything we broke down in credit scores, including the breakdown of what a credit score actually is, the agencies that report them, what affects your credit scores, the importance of the score, credit cards and the interest rate, and then of course, what the credit cards can do for you when it comes to rebuilding your credit score. So I hope you enjoy the series. When it comes to understanding your credit score, managing credit utilization responsibly are essential for your financial well-being. If your score is low, you will pay more things for your entire life without having that payment history. So in today's video, guys, we're going to be defining the credit score, breaking it down, the things that really do affect it. Also talk about a couple of detailed points on what you can do to really make sure that your credit score stays up. That way you are approved for loans and you are paying as little interest as possible during the life of that loan. So number one, guys, the definition of a credit score, it is a 3-digit representation of the individual's assessment, creditworthiness to repay a loan. So this could be a mortgage, this could be a credit card, this could be an unsecured loan, it could be an auto loan, it could be anything. It gives you a number essentially that is assigned to you. That is the likeliness and the likelihood of you to repay anything that is borrowed based on previous history. Now this does get a little bit tricky when it comes to someone who doesn't have a credit score or has damaged credit, poor credit, no credit, because the score will either be much lower or there will not be a score at all, which means you can find a lot of very cheap ways that we're going to be talking about in the future, guys, to rebuild that credit score or actually establish credit. That way you can get a lower rate for your loan. Up front, it might cost you a little bit more to rebuild. It might cost you a little bit more to establish credit. But overall, there are a lot of programs that are relatively cheap or inexpensive that you can start building the credit score. Now, number two, the numeric range. Credit scores typically go from 300 to 850. That is right. In 16 years of being in financial institutions, I have not seen an 850 credit score. I don't even know if it's possible. Theoretically, that is where it caps, guys. 820, 830 is the highest that I've seen. The higher the credit score, it indicates better credit worthiness. Lower score suggests a high risk to lenders. Now, again, if you have a lower credit score, the chances of you getting approved are much lower based on your credit history, which is the reason why you have to monitor it and you have to check it on a regular basis. There are credit cards, there are banks, there are credit unions. There are a ton of places that will monitor your credit. When you think of like Credit Karma, that will do it for absolutely free, guys. This way you know where your score is at before you go to apply for a loan, before you apply for a mortgage, things of that nature. You know exactly where your score is or kind of a general idea. Now, the problem that we see with Credit Karma and a few other of these that kind of track your credit score is a lot of times it's not accurate. It might be 20, 30, 40 points off. However, knowing that you're paying your items on time, you're keeping the ratios of your credit cards down low, you will have the ability to borrow and you will be approved when you are borrowing. Now, calculation method. Now, the calculation in the credit scores are based on the information that is housed within the credit reports. This is the reason why freecreditreport.com is a vital tool, guys. You have to go in there and you have to make sure that everything on your credit report is accurate. That is the big important thing, guys. If there are things on your credit report that shouldn't be there, inaccurate amounts, closed accounts that are reporting, open accounts that were not yours, you have to make sure you're responsible for your credit, cleaning it up and making sure that everything is correct in there. Now, what does make up the credit score itself? There are 5 different buckets. Number one being the payment history. Payment history, of course, is the biggest piece of your credit score. Credit utilization, meaning the amount you have available to borrow in relationship that you have borrowed. This, again, is going to make a big difference. This is another 30% of your score. So between the payment history, the credit utilization, you are looking at 65% of your score right there, guys. That is the bulk of it all. If you make your payments on time, if you keep your utilization low, you will have a good credit. Length of credit history. This is one, guys, that just takes time. This, again, is something that overall it is going to take a multitude of years to really build up the length of credit or your credit history. So if you look back in, let's say, the last 12, 24, 36 months, you have had everything paid on time, you will have a decent score. Regardless of some of the utilization, even if it is a little bit high, the score will still be relatively high in the BC range, I would say, at that point. Next part we look at, guys, is the types of credit. And then, of course, the acquiring of the new credit are the final 2 components that does comprise your credit score. Each factor does carry a different weight in calculation of your score. But again, big things to remember, guys, the payment history, the credit utilization are the two biggest factors when it comes to the credit score. Number 5, we get into the credit risk assessment. This is what lenders use to assess the credit risk, or again, the ability for the individual to repay a loan. If you've repaid loans and you've always been on time with payments in the past, there is nothing that says that you're not going to pay them or you are going to pay them in the future, guys. So they are making lending decisions on the past performance of your credit, which of course yields you a score to make informed decisions. And there are also a lot of guidelines that institutions have to follow for loan approvals and setting interest rates, guys. So again, the difference between, let's say, having A+ credit with an auto loan, A+ credit, you might be at 6%. If you're running at D or E credit, which is about a 590 or less, you might be looking at a 15 to 20% difference in your rate that you are going to get for a loan, guys, which again, astronomically speaking, looking longevity wise, you need to improve your credit score. You need to get the payments down for cheaper. They are making more money off of you at financial institutions because you do not have good credit. Now, credit score frequency. This is something, guys, again, a lot of credit monitoring services are out there that are absolutely free. Credit scores in this can report. Now, credit score frequency as well. You have to make sure that you have utilization with the credit score. I know a lot of people like Dave Ramsey, say, pay cash for a lot of things, stay out of debt, do not use credit cards, always use your debit card. For most of us, that is not there isn't an ability with that, guys, because when you go to make a larger purchase, whether it is a home, whether it is a car, if you do not have credit and you're not utilizing any of your credit, you will have no score and then no history in turn, meaning that lenders are going to charge you a lot more, or the lender just might not approve you at all because you don't have credit history. Now, what I advise, guys, is if you don't have a mortgage, you don't have an auto loan, carrying at least 1 or 2 credit cards and carrying them at a 0 balance. So the credit report looks for really 2 different things, guys. 1, did you make a purchase on the card? 2, did you make a payment on the card? That's it. So what we advise for a lot of younger individuals or even rebuilding credit scores is, let's say you have a credit card, you're going to utilize that credit card for gas and gas alone. So anytime you need gas for your vehicle, you are utilizing that card specifically to only put gas in your vehicle. Every 2 weeks when you get paid, every month when you get the bill, you're paying it off in full. Again, building up that credit history, keeping the capacity of that card at 100%, meaning you are not carrying a balance on that card. Now, credit score impacts. Major life events, taking out a loan, applying for credit will influence your score. Now, depending on how strong of a score you have, it'll have a little bit of impact if you have well-established credit. If you have almost no credit, it can have a significant impact because, again, they're basing it on the credit that you do have. Late payments, defaults have a massive negative impact, guys. Essentially, if you're late one single time for 30 days, so if you're paying your bill and you are more than 30 days late, that can wipe out 24 months of on-time payment history. When it comes to your credit report, that can absolutely wreck it, especially if you are a younger individual that is either establishing credit for the first time or an individual that is repairing or rebuilding credit. One missed payment, guys, that is the reason why we talk about the automation, making sure that you are using the automation and payments, at least the bare minimum payments on everything are set up. That way you know that it is paid in full. Now, understanding this credit score ranges, they go from excellent, good, fair, poor, and bad. Now, this essentially can also be signed a letter. So excellent will be A, either the B tier or the A- tier can be good. And then C for fair, D for poor, and then E for bad is usually them. This is where they do the determination of what your rate is going to be. Like I said earlier, if you're at an A or an excellent credit, you're going to get a 6% for a loan. If you're at, let's say, a poor or you're at a C credit, chances are you're going to get probably a 10 or a 12. If you're bad credit, it could be 15 to 20%. Again, making the utilization, you have to improve your credit, guys. Now, credit score importance goes beyond loans. This, again, is a pivotal point, guys. If you're looking at your credit score, job applications, rental applications, insurance rates, most places do utilize a credit report to know exactly what kind of person or what, if you have good credit, if you have poor credit, depending what your financial life looks like. Now, there have been studies that correlate credit scores, the ability to repayment, the financial life, the financial aspects into the workplace with, job tardiness, absenteeism. There's a lot of things that they have kind of correlated through time, which is the reason why a lot of job interviews or job applications will have a consent to pull your credit. Rental applications, the exact same thing. So if you go to rent a place or if you do go to get an apartment, they will pull your credit knowing exactly where you are. And if you live in Michigan like I do, the insurance rates are based on credit, guys. If your credit score goes down, your insurance rate will go up, and it will go up considerably. The credit score improvement strategies, there are a couple ways that you can improve your credit score, which we're going to get into in the next couple videos. But paying your bills on time, again, are the biggest one. Reducing and eliminating your debt, as well as disputing anything that is inaccurate on your credit report. Guys, you have to make sure everything on there is yours and yours only. So guys, that'll do it for the basics for our credit scores. Let me know in the comments what you guys think, and I'll catch you in the next video. When you think of your credit report, where does it really come from? In today's video, we're going to be looking at the reporting agency in more detail, guys, and how the score is actually produced or created. The definition of a credit reporting agency, or the CRA, is a credit bureau, also known as a credit reporting agency, an entity that controls, maintains credit information on both individuals and on businesses. That is right, guys. Businesses can have credit as well. They can be established as a business. Now, one of the things to remember with the credit reporting agencies are they are private institutions. These are not government entities, which means we've seen in the past where a lot of news has said that they had breaches, they had inaccurate data, they had wrong reporting, resulting in people like you and I getting a much higher rate or having a much lower credit score and then paying more for the loans that we have. Now, there are three major credit reporting agencies: Experian, Equifax, and TransUnion are the three ones, guys, and they play the central role in the United States, depending on where you live, to report and maintain the credit reports. So essentially, if something is reported to one of the three bureaus, the bureau actually has to transfer it or has to share that information with the rest of the bureaus to try to stay as uniform as possible. Now, what a lot of people notice is when they go in there and they go to freecreditreport.com, they pull the reports. Some of the reports can be drastically different. Now, I know that does not give you a score, but we've seen, again, a lot of things that are reported on one versus another versus the third, or vice versa, that they are not literally mirroring each other between all of these bureaus. Now, data collection sources. So they collect data from a ton of different places, guys, including lenders, credit card companies, public record information, and financial institution information. Now, credit reports we know have been used in a lot more things than just getting a loan. We have seen it if you're looking to do a rental property, if you're looking to get an apartment, they will pull your credit. If you're looking to do a job application or looking to advance your career, most places nowadays will pull your credit. When you're looking to get insurance for your home, whether you're looking to get insurance for your auto loan, they will pull credit. It is kind of crazy, guys, that so much of the data with the inaccuracies that we see are still used for so many things in America. The next part we get into is the credit reports, guys. This is a compilation or a compiled data for each report for each individual that is usually based on social security number. That is how it pulls, guys, and it is because these social security numbers are unique to the individual. A lot of times, if you have a John Smith, if you have a Jane Doe, you're going to have a ton of people with that identical name, but the credit scores are going to be different, of course, for those individuals, which can kind of be separated by the social security number. Now, credit reports provide a very detailed history of an individual credit related activities. And also, this is what is based on the credit worthiness of an individual. So if you've had credit, you've had some late pays, you've had some delinquencies, you've had some charge-offs, they're going to give you a much lower score because the probability of you repaying and repaying on time is much lower. And that could be costs that are going to be incurred from that financial institution, which is the reason why risk-based pricing, they will give you a higher rate than somebody that has A+ credit that they know is going to pay them back. Now, the score generation itself is a very specific and sophisticated algorithm that they use to come up with a score. And again, this is to help lenders assess the creditworthiness of an individual or a business that is looking to borrow money. So again, the generated score just really goes through an algorithm similar to what we see with YouTube. It says, hey, based on the history that you've provided me, this is the score that I am returning, and this is the reason why. Now, a lot of people have also said that AI generated scores or AI credit scores are coming in the future. There are a lot of companies that are testing that, meaning they will go above and beyond just the algorithm that they're running and get more in depth to exactly how and why the behaviors behind the individual are really built, possibly giving you a higher score, again, depending on the AI model. Now, of course, with credit reports, guys, comes the accuracy and the dispute process. It is very important, and I really urge you, pull your credit report, guys. You get one full free copy per year from all three of them. Again, it will not give you a score, but you can make sure that everything that they are reporting, everything that they have on your credit record is 100% accurate, because in the event that you have to get a mortgage, you have to get a loan, you have to do anything where it does involve your credit, you want to make sure you have the best possible score that you can completely have. Now, if there are inaccuracies in there, if there are things that are on there to dispute the accuracy of the information, it does take time. For majority of bureaus, you're talking 2, 3, 6 months to dispute and remove items that are on your credit report, if not longer, depending exactly where it is from and when it is from, which again can really delay you having the ability to get what you need with the utilization of your credit. Now, credit contents, what is really included in the report, guys? It includes personal information, credit information, payment history, credit inquiries, public records, which include bankruptcies and liens. Also, if there have been any freezes, any alerts, any fraud alerts, anything like that. So personally, in my financial institution, when we pull your credit report, it tells us a ton of information, guys. It's very, very hard to see the black and white when you pull someone's credit report and you see a bankruptcy, delinquency, when you see, multiple addresses, you see multiple accounts, a ton of inquiries. There's a lot of things that go into making up that score, which we really dissect in my professional life. Now, number 8, guys, we get into credit freezes and fraud alerts. They allow you to freeze your credit report. I cannot stress this enough. Just like the other thing, guys, freezing your credit report is super imperative. We see a crazy amount of credit card or as credit report fraud, where someone will actually get a hold of your social security number. They will open bank accounts. They will take out loans. They will do anything that they can. But now the credit freeze does really lock up the credit report, meaning if an institution goes to pull it and there is a freeze, they will get something back just saying this is frozen. Now, to unfreeze, all it takes is a phone call and a PIN number. Usually about 5-10 minutes, you can unfreeze a credit report. The next day, it does go back into that froze status. But again, thinking big picture, guys, how often do you use your credit? For me personally, it's probably every 3 to 5 years, if not a little bit more. So making sure that it is and stays frozen, especially when it comes to not only you, your spouse, but also your kids. There has been a lot of news articles, if you do a quick Google search, about that credit reports and credit hacking has been very prevalent to minors and their social security numbers. Again, fraudsters are using the information that they can obtain to really make, and really when your kid goes to go ahead and start establishing credit, they say they already have credit lines. They might be delinquent. They might be charged off. Good luck. You're going to have to start the fighting process with that. Now, of course, with this comes a bit of regulatory compliance. They are required to comply with the Fair Credit Reporting Act, the FCRA, which outlines the standards for collecting, maintaining, and disseminating credit information. Now, this is, of course, one of the big changes that we're looking at in 2024. If Biden has his way, we will no longer have medical collections on credit reports, which means for a lot of Americans, which I believe they said about 65% of Americans that have medical collection on the credit reports, they're going to be wiped off in their entirety, which will be absolutely amazing. And the final point of this, guys, is looking in the financial decision making. Again, lenders rely almost solely on the information that is provided when it comes to making a loan decision, when it looks to approving loans, approving credit cards, even other form of credit. Even if you're looking at mortgages, mortgages have government guidelines that you have to qualify with a certain score. If you do not have that score, unfortunately, you're not going to be able to get a mortgage, which is the reason it is imperative, guys, that you maintain and you monitor your credit. If there's anything inaccurate in there, you make sure that you get it corrected, making sure that the credit is not only monitored, but keeping the credit frozen. That way you have the ability to freeze and unfreeze as you do need it within the credit report. So guys, just wanted to break down a little bit more when it comes to the credit reporting agencies and also the credit report itself. So let me know in the comments what you guys think, and I'll catch you in the next video. When it comes to your credit score, it is the single biggest most thing during your adult life that is going to be either make it or break it depending on where your score is. If it is going to cost you an incredible amount of money that you're paying over your lifetime in interest, or are you going to get approved for loans at the best rate that they offer at financial institutions? In this video, we're going to be breaking down the credit score and continue our journey, guys. This is the third video in the series, so let me know in the comments below what you guys think. First off, payment history. It is the single most biggest part of your credit score. It accounts for 35% of your score itself. This is making timely, on-time payments to credit obligations. So if you take out a loan, you have to make it your payment on a regular basis and make it on a specific time frame. If you're late, this is going to hurt your score. If you are default, meaning that you're not paying anymore, this is going to devastate your score. If you do bankruptcy, this can absolutely crush your score, guys. Again, payment history, focus on making the payments on time. Now, this also includes minimum payments. If your credit card minimum payment is $25, make sure everything you can do in your power to make at least that $25 payment. If you can't go above and beyond to repay that debt, make sure the minimum payment, if not, the credit in the payment history is going to be affected. Second part we look at is the credit utilization. Now, this is the available credit in relationship to the credit score or the credit that you're using. So if I have a credit card with a $10,000 limit, I'm using $5,000 of that, which is borrowed. That gives me a 50% credit utilization, meaning I am using half of the line that is available. Lower utilization rates are generally favorable and will increase your credit score. That is right, guys. Same scenario, if I go from that 50% utilization down to a 20% utilization, my credit score will improve because I'm using less of my card. That accounts for 30% of your score, which again is a major part. Now, a couple of caveats to this. This is the reason, guys, if I have, again, that $10,000 limit with $5,000 used, and the credit card company agrees to increase my limit. So if my $10,000 limit now goes to a $20,000 limit on my credit card, now my 50% utilization goes to a 25% utilization. This is the big reason, guys, where a lot of people say, hey, if I close out a card, is it going to make a difference? Yes, it will, and yes, it can. And the reason being, not only are you wiping out some of the credit utilization ratios that you do have, but you are also wiping out some of the payment history. If it's a card that you've had for 3, 5, 10 years, the payment history will actually expire. The credit utilization will do the exact same, guys. So you won't have as much available credit on your credit report. So again, in this scenario, if you have two cards, both of them have a $10,000 limit. If you close out one of them, you're wiping out half of the utilization that you do have, depending on what the balance is. Now, the third one we look at is the length of credit, the credit history and the length. This is 15% of your score, guys. The length of credit history influences your score. Longer credit histories are generally viewed more positive and will yield a better score. Now, of course, if a lender pulls your credit, looks at the credit, sees, hey, this individual has, 5, 10, 15, 20 years of perfect, great payment history. Might have even been some bumps where there's a missed payment kind of here and there. But overall, the credit history is going to show your ability to pay and your credit worthiness, which is going to yield you a much better rate if your score is there. Now, number 4, we look at the types of credit. This accounts for 10% of your score. The varying types of credit includes credit cards, mortgages, installment loans, which are fixed rate, fixed term, can impact your score both positive and negative, depending on if you're managing it responsibly. Those are really the 3 buckets, guys. When you look at a credit report, one bucket is kind of the unsecured debt or the revolving debt that you carry, whether it is like a home equity line of credit, where it is a revolving debt, a credit card, things of that nature. They report as that revolving line. Mortgages, of course, on the credit report as the real estate or the mortgage balances. And then anything that is set rate, set term, like your fixed rate, fixed term, your auto loans, your personal loans, your unsecured loans, anything that is a set term. So in 60 months, you're going to pay off the loan. They will fall into that installment loan bucket. Majority of lenders like to see a mix of credit. A lot of people, younger generation, may not have a mortgages, but credit cards, installment loans, you have to build credit, guys. And I cannot stress this enough. When you turn 18, start building your credit, start and learn to be responsible with your credit. It is going to save you money for your entire life, period. That's it. It's been proven that someone with poor credit in comparison to someone with good credit, the individual with poor credit pays about $500,000 more over their entire life in higher rates and fees than the individual that has established and well-established credit. But that means the individual with lower credit pays more for credit cards, pays more for loans, pays more for mortgages. Every single utilization that they have with that lower score, they are going to be paying a much higher rate. Number 5, we get into the new credit accounts. This is another 10%, guys. Opening several new accounts in a short amount of time can be viewed negatively because you're going in there and you're getting a lot of additional credit. Now, we see this with individuals. They'll go out, they'll open 3, 5 credit cards at the same time. Don't really know the logic short of just establishing and building up that credit. That can be viewed negatively because essentially the individual that opens 5 of those cards could go out, max out all of those cards in one day, and then of course they will absolutely tank their credit. But the amount that you have available, and this even comes into a factor when you're doing mortgages, is let's say you have $100,000 of available credit out there. A lot of institutions will want to cancel or lower some of those limits on those cards to get within the guidelines of that the government has put in place. That way you can't go out on a Tuesday and spend $100,000 and max out all of those cards. Now, the recent credit activity, this is the opening and closing of accounts, which can affect your credit score as well. You have to make sure, guys, that you're not running through a lot of revolving. 1, 2 inquiries a year are normal. When you start getting 3 to 5, it gets a little excessive. But I have seen people that have 20, 30, 40 inquiries in the course of 12 months, which is absolutely insane credit utilization and activity, and it drives their score down a lot. Now, number 7, we look at public records and collections, guys. Anything such as bankruptcies, tax liens, collections will significantly impact and lower your credit score. So keep that in mind that when you're starting to get collection bills in the mail, is it something that you can work with the collection company? When you have tax liens, guys, those have to be paid. The government can do a lot of different things, especially with the bankruptcies. See in the bankruptcy exactly what your options are for the repayment. A lot of people just want to wipe the debt clean, but it is a debt that is owed to institutions. Number 8, we look at the credit inquiries. When you do a credit inquiry, this is a hard inquiry, as they say. It has a very short, minimal impact on your score overall with the inquiries. But you have to make sure if they're going to pull your credit, are they doing a hard inquiry or is it a soft inquiry where it is not going to affect your credit? Number 9, we look at the debt levels, guys. This is the total amount you owe in absolute terms. It is what you owe overall. If you're an individual and you have $500,000 in debt and you're making $50,000 a year, that is going to be a giant red flag. Even though you have a good credit score, your debt to income ratios and a couple other factors are going to be taken into account. And you're probably not going to be able to borrow because you have an excessive amount of debt. Not only will that affect your credit score, having a lot of debt, having a lot of revolving debt, having high auto loan payments, high mortgage payments, but again, a lot of lenders will see that you're really overextended in relationship to your income and they will not lend to you. And the final one we look at, guys, is the financial behavior, which is the most important that I focus on in this channel. Maintaining a mix of credit, paying all of your bills on time. Again, even if it is the minimum payments, guys, you have to pay your bills on time. There is no ifs, ands, or buts about it. Making sure that you are making those payments on time. Managing your credit responsibly, meaning that you are not going to have all of your credit cards maxed in their entirety, maxed out at 100% of that utilization ratio every single time that you're not paying your cards off or paying your cards down on a regular basis. Because essentially the way the credit bureaus and the way financial institutions look at it is if you're maxing out all of your cards or if you're carrying a ton of debt, you are kind of supplementing your income with debt. So if I'm not making enough money, let's say I make $5,000 a month, I'm spending $6,000 a month, 1,000 of that is going onto credit cards every single month. That is the reason I have the higher balances on the cards, because I'm not living within my means when it comes to the credit score. All right, guys, so I hope that it really summed it up with the credit score, kind of the utilization, the credit usage, and a lot more knowledge with videos to come. So if you like the content that I provide, consider subscribing to the channel, and I'll catch you in the next video. Have you ever taken a minute in thinking about how important credit scores are when it comes to lending decisions, when it comes to getting loans, when it comes to getting a job, getting a place to rent? Credit scores are what they use to really determine your credit worthiness and if you're going to have the ability to repay. In today's video, we're going to be breaking down the importance of the credit score and where we're seeing them used in kind of a broad spectrum, with number one being loan approvals and the interest rates, guys. Now, financial institutions, credit unions, even online lenders do use a credit score to determine what your rate is, which means better credit score, lower rate, lower interest, lower payment. Lower credit score means higher rate, higher payments, higher possibly loan denials. It is really the catalyst for your lending and your financial journey, which of course can have a huge impact in everything else, including how you're budgeting when it comes to the money that you're bringing home in relationship to the money that you're sending out or the money that you're paying in debt. If you have a poor credit score, you are going to have a much higher rate for pretty much everything, including credit cards. When you look to borrow, you are going to get and qualified for a much higher rate, which could cost you tens of thousands of dollars over the first couple years that you are starting to borrow money with that lower score. Now, higher score also generates lower interest rates, meaning again, the likeliness of you getting approved is going to be definitely a lot more favorable, but it also allows you to borrow money a lot cheaper. They said between having great credit and having poor credit usually costs someone about $500,000 over their entire life. Because essentially, when you think big picture, you're going to be paying more for things forever. If you do not spend the time and really be diligent in improving that credit score, you're going to pay a higher rate than someone who has good credit for your entire life, guys. Do not do this to yourself. Number two, we look at credit card approvals. Credit scores influence not only credit card approvals, but also the rate that you pay for a credit card. Where you might have great credit, you get a 12%, you get an 18, a 22. Depending on the rate that you get, even at some financial institutions, if you have a 690 or better credit score, your rate is 9.75, and that is a fixed rate, guys, for a credit card. That's right, it is not a variable rate, it is a fixed rate, with the average credit card rates running around 24%. If you're an individual with poor credit, chances are you're more in the 30 to 36 range per month that you're paying in interest, guys. It's kind of incredible. When you look at your statement, take a minute and really look at your statement. If you got it online, pull up the app, pull up whatever and however you pay your bill. Look exactly what it says in there. Most of them will have a little block that say, if you make the minimum payment, this card will take you 11 years, 15 years, 22 years to pay off in its entirety, just making the minimum payment. There's no reason, guys, that you want to go use your card for Christmas, pay for it for the next 22 years because you're making those minimum payments. Now, you can also, improving your credit score, apply for a different card, get a much lower rate, do a balance transfer, and slowly eliminate that debt that, again, you're not going to be spending, 15 to 22 years paying back. Number three, we get into renting a home. That is right, guys. When it comes to renting a home, a majority of landlords will do a credit check before they will rent out to a property, which if there's a place you're really interested in, if it's, good location, good schools, if it's one that you want to get into, credit score could be holding you back. With a lower score, chances are you're not going to get approved because you're not proven and have not shown the willingness to repay. Higher credit score enhances one's rental applications, may lead to more favorable leasing terms or even more favorable dollar amounts, which means that a landlord might take a little bit more risk on a lower credit score, but in turn, to get that kind of risk reward, kind of the give and take that they have, they will charge you a higher rate than they will for someone else, which means, again, credit scores can affect when you're renting a home. They also do the same for apartments. When you go to get an apartment, they will run your credit. Some of them even report to your credit, which means if you're paying your monthly rent, chances are, depending on the complex that you rent, you will have your rent reported to your credit. And I've seen this more often in the last couple of years. Now, number four, we look at insurance premiums. That is right, guys. From good credit to bad credit, it is kind of crazy, but a lot of insurance companies use credit scores to determine premiums for auto loans and homeowners insurance. Good credit score means you're going to be paying less. Now, how much less, you might question? Between a good score and a bad score, some companies have charged 25 to 30% more monthly premiums for someone who has poor credit. So again, big reason to really reevaluate your insurance. Make sure you're with the right company and the company that you're going to get the best rate, but also the best service. Number 5, we look at employment opportunities. That is right, guys. Part of the employment process, a majority of larger companies will go and do credit checks. So again, if you're looking at a job, you're super excited, the interview went great, they pull your credit. Unfortunately, it's not on par, or you have damaged or poor credit. All of a sudden, you're getting a denial letter that you did not get the new job, and someone that had an A plus credit rating did get the job. Positive credit history reflects positively on the individual's reliability and trustworthiness. Now, there have been a ton of studies about this. Is credit scores in relationship to call-ins, to sick leave, to issues with the job. There is a correlation between those, between the reliability and the trustworthiness of the individual, if they have a good credit or bad credit. So again, take personal accountability, guys, and really think about where you're at with your score. Now, security deposits. A lot of landlords and utility companies may require higher security deposits from individuals with lower credit scores. That is right, guys. They don't want a month rent. They might want 2 months rent just because your credit score is lower. Utility companies might want something to hold as a security deposit because they're not sure, kind of questionable on the credit report, if you're going to repay them and if you're going to repay them on a timely manner. Now, it does cause companies or cost companies money to get their money. So if you're paying your bill late and they're sending you late notices, that's why a lot of these companies do have late fees, is it does cost them money not having your money. Essentially, for them to be able to collect, it is really substantial and really important that you do pay everything on time. Now, higher credit scores also give you negotiating power, guys. You have the ability to look for more favorable terms and conditions when it comes to loans, when it comes to credit cards, if you have a good credit score. Now, for instance, using the same scenario, if you have a credit card that's at 30%, you could call that credit card company and say, hey, I want a much lower rate. What are you guys offering? If they don't offer what you want, you can look at other avenues, look at other cards, because you have the credit score to back it, giving you the negotiating power with a lot of different companies. Number 8, we get into the financial planning and budgeting. Regularly monitoring, maintaining good credit score shows financial discipline. If you have a budget, which a majority of people do not, I recommend budget above everything else, guys. You have to make sure that the money you're bringing in home to the money you're spending, you are not in the red. It is not going to work if it is. It encourages financial habits, effective budgeting to ensure that all of your bills are paid on time. Like we talked about in the last video, 35% of your score is your payment history, guys. Major, super important to not miss any payments. Set them up automatically. When it comes to credit cards, when it comes to loans, even making the minimum payment automatic is better, guys. Go ahead, set it on. As long as you know the money is there, the bill is going to be paid. There are no late fees. Your credit score is going to be stellar because you're paying everything on time. There are no late payments. And number 9, we get into the access to financial products. That is right, guys. There are a lot of financial products that do require a significant credit score or a higher credit score, including personal loans. Mortgage loans, which are government regulated, require a minimum credit score. If you fall below the minimum credit score, unfortunately, they cannot legally lend to you because of your credit score. It really opens up the entire range of financial products, which again, can make your life easier, can make your life more efficient, and also can make things cheaper. And the final one we look at is building a positive reputation with the credit score, guys. Maintaining a good credit score contributes to positive financial reputation. This can also reflect responsibility in how you manage your credit and really the overall fundamentals. If you're going to work and you're worried about your financial plan, you're worried about your budgeting, you're worried about your credit score, all of the time, these are things that are relatively easy to manage, and they get a lot more easier, and they really do get easy when you're used to managing it and managing it automated, taking it kind of out of sight, out of mind, making sure and knowing that everything is going to be paid on time. So guys, definitely wanted to cover the impact of the credit score and why it is so important as a driving force within your financial freedom and really being completely debt free. That'll do it for today's video, and I'll catch you in the next video. When you look at a majority of credit cards that people have, they are viewed as bad, they are viewed as negative, they are viewed as very high interest. But that doesn't have to be the true factor when it comes to credit cards. They can be used as a tool to build and maintain your credit, improve your score, and give you the ability to actually have the buying power within a very short amount of time to cover your day-to-day expenses. Today's video, we're going to be breaking down credit scores and credit cards and kind of the relationship between the two, starting with the credit utilization. Now we know from previous videos, this is 30% of your score, guys. Now this is how much credit you have outstanding in comparison to how much credit you're actually using, or the utilization number. This is broken down into a ratio. So if I have a card with a $10,000 limit, I carry a $5,000 balance, I am at a 50% credit utilization, which is viewed from credit card companies as negative. It is viewed that I am living outside of my means because I am supplementing my income with credit card debt. Like I said before, it is a utilization, it is a ratio that is really determining the factor when it comes to this, and that 30% that makes up your credit score. So what does this mean big picture? You want to have a card that has a significant limit on it. If it's $5,000, $10,000, $15,000, regardless of what it is, you do not want to carry a balance on the card, which means credit utilization is going to remain at zero. And it really is going to be twofold, guys. Number one, with that credit utilization at zero, you're going to have the best possible reporting to your credit score. And number two, if that card is paid down to that zero limit or that zero balance, that means that you're not going to pay interest. Now, for a majority of credit cards, if it is paid in full, you will not pay interest. One caveat to that, guys, you have to be careful because a lot of cards that do come with rewards can come with annual fees. You really have to shop around and figure out what is really going to be the best card for you. And I really do not recommend, Dave Ramsey style, using cards at all if you carry a balance. Now, I know he talks about, that credit card rewards program has never made millionaires. However, it can pay for and cover significant expenses and really offset some of the things that you're going to buy anyways. But again, it is a tool that needs to be used as such. Number two, we look at the timely payments. Credit card payment history is a crucial factor in creating and maintaining that credit score. This is because credit cards are perpetual, meaning there is no end to them. You can open a card today, you can have it for 10, 20, 30 years with the same institution and building up 30 years of payment history by having that credit card. And as a result of that, that covers the payment history, which of course is 35% of your score. Another 30%, of course, is that credit utilization. Consistently making on-time payments to credit cards will build that positive credit history. With that being said, it really looks at two things when it comes to the timely payments or when it comes to the credit card. One, was there a purchase? Two, was there a payment? And then, of course, the third one is what is the balance that is remaining on the card, which in this scenario, we want to keep and maintain at that zero balance. So that might mean using your card every 2 weeks you get paid, paying off the card entirely, or when you get the bill in the mail, making sure that you always have enough money set aside to, again, pay off that card in its entirety. Number three, we get into credit limit increases. Now, this is, of course, the credit limit increase is what can adjust and what can affect your ratio. Now, this can affect positive and negative, guys. Both sides of this you really have to be careful of, because with the credit limit increase, if that $10,000 card goes to $20,000, it is going to improve the ratios that I have on my card. However, negatively impacting, if I close that card out, I am losing $10,000 of that credit line. If that's one of the only cards, or let's say one of two cards that I have, you could be again messing with that credit utilization ratio, which will have a huge impact on your credit score. If entirely between two cards, I have a $20,000 limit, I have $5,000 on the card, which we talked about earlier. If I close one of those cards out, my utilization ratio goes from a 25%, having that $20,000 line, down to a 50% utilization, and again, having a massive impact on my score. Now, types of credit we look at as number four, guys. Credit card accounts, including having a mix of credit, is really important. Not just all credit cards, but credit cards, installment loans, mortgage loans. You need to have a mix of credit to really build up the score to where you want it to. If your score is primarily and only driven by credit cards, it is going to be pretty limited, and it is going to fluctuate greatly depending on what you build. Now, for a lot of companies, they do want more than one form of the credit mix, really, meaning that credit cards alone are not solely going to drive that score. Number five, we get into the credit cards, and again, closing them out can significantly impact your score because this will impact the total available credit that you have. In addition, if you're closing out credit cards that are older, this could also create a deficit when it comes to that payment history, because essentially, again, if you had that card for 30 years, you're wiping out 30 years of payment history when you close that, and then it will default to the next oldest credit line that you have, which could only be, let's say, 2 years, 3 years, 5 years, whatever it could be, which could, of course, potentially lower your credit score by a incredible amount. Now, of course, number 6, we get into the credit inquiries. As you're applying for credit cards are a hard inquiry, which can temporarily lower your card. Make sure, again, that you're really managing the credit. You don't want to be the individual that goes out and opens, 27 credit cards. 1 or 2 is really all that you need. Do your research, make sure you know exactly what the card is, what the benefit of the card is, and what you want to get out of it by not carrying a balance. Number 7, we look at the balance transfer and the impact of this. Now, balance transferring between cards, of course, can impact your score. Again, this can mess with a couple different factors. It could see a decrease because of the inquiry. Also, you could see a decrease depending on what the factors are of the new card and also what the available limit of the new card is. If you open a card with a $5,000 limit, you throw $5,000 on it the next day, chances are your score is going to have a pretty decent impact in a negative way that you do not want. Now, credit monitoring services is number 8. If you look at Discover Card, if you look at a majority of the major cards out there, such as Chase cards, they do offer credit scores and they do offer credit monitoring. For a lot of those, they come free, which is another reason, guys, kind of a perk to have a credit card is even with the card that I have, it does monitor all of my credit. So if I do see significant changes in there, I can look and see exactly why, because the credit monitoring is offered free just for the fact that I carry their cards. Number 9, we get into the rewards and the benefits, guys. This is the very, very slippery slope. A rewards card is never beneficial. That is right, guys. Let me say it again. A rewards card is never beneficial if you are carrying a balance. Whatever the rate is on the card is the rate that you're going to be charged. There is not a chance if you're not paying that card off in full. You do not want a rewards card because you are paying for the rewards that that card is offering. I see people that get, 1%, 2%, 3% cash back, carrying an $8,000 to $10,000 balance on a card. That is running about a 26 to 28% increase. That is right, guys. Reward cards usually have a significantly higher interest rate because, again, if you're carrying a balance on that card, you are paying for the rewards that are on that card. There could be benefits that come with it, but again, the only benefit that you're ever going to find, and that is truly a benefit to a rewards card, is if you're only utilizing it to, 1, buy things that you're already using, like monthly expenses. For instance, with my card, I put all my regular expenses on there. This includes utilities, this includes the phone bill, this includes the internet bill. Every 2 weeks when I get paid, the card is paid off entirely. I'm not putting excess spending on there. I'm not putting a lot of things that are in excess. I'm really sticking to the budget, making sure that I'm getting rewarded for what I am using. And again, this can come with a great benefit. I actually have a card through M1. I have a link right down below if you do want to check it out. It's called the Owner's Reward Card. So they do offer cash back from a bunch of different companies that can tier as high as 10%. With that being said, they give it back to you in a stock portfolio. That is why it is called the Owner's Reward Card, is the rewards that you get, the cash incentive that you do get from that card goes back into a portfolio that can buy stocks, the VOO, you can buy mutual funds like Dave Ramsey, whatever it is, guys. But as long as I am paying that card off every 2 weeks, I am accumulating stock in companies that I can kind of divest into. And that's exactly what I'm doing. So far this year, we've made about $1,200 in rewards from that card, and it has costed me $0 because I have not paid interest, not one single penny in interest on any of my cards in probably almost 15, 20 years. I do not pay interest, but I do reap the benefits of the rewards. That portfolio has grown considerably. My $1,200 in rewards is about $1,700 right now, again, with that growth aspect. And I'm going to continue doing that year over year. And the final one we look at, guys, is credit card debt management. This is the biggest important part, guys. Like I said, you should never carry a balance on a credit card. It should always be $0. I know as a nation, as the United States, we are carrying $1.03 trillion in credit card debt, which is kind of incredible to think about, a staggering amount like that. So there is a lot of credit card debt out there. And of course, when it comes to credit card debt, you're paying probably the highest interest that you'll see of anything that you will ever borrow. So get those credit card balances down, guys. Make sure that you're not carrying them, especially if you have rewards cards. Look at how much you're getting in rewards in comparison to how much you're paying in interest on a monthly bill. Really do the math, break it down, guys. See if that rewards program is really worth it. All right, guys, so that'll do it for today's video, and I'll catch you in the next one. When it comes to credit cards, do you really know what you're paying for? Not only the rewards program, but also the APR, or the annual percentage rate that you're paying on those cards. Do you have a fixed rate? Do you have a variable rate card? These are the things you really have to take a look at and examine when it comes to the card, and the things we're gonna be breaking down in the video today. Number one, starting with the APR, guys. This is one of the absolute biggest overlooked things. When I talk to a lot of people in my professional career, most people have no clue what APR they are paying on credit cards, where their mortgage is at, where the auto loans are at, unsecured loans, any of the debt that they have. Most people do not know exactly where the APR is, but I want to show you how this affects it. As we see right here, this is on Discover's website. This is a credit card interest calculator. Now, doing a quick Google search, Bankrate brought up the average interest rate of a card is 28.93%. So we went ahead and plugged that in there, guys. We have a $10,000 balance. That puts our minimum monthly payment at $244 on a $10,000 balance, which is kind of crazy. But looking even further down here, guys, it is going to take you 155 months to pay this off at your $244 monthly payment, which means on a $10,000 balance, you are going to pay $27,701 in interest. That is right. You are paying almost 3x what you do have borrowed on there, which again is a great rate of return if you can get it. If you're paying it, you're just going to be really without up the creek without a paddle because of this interest. Now, looking here, what would happen if you adjust your monthly payment? This again shows the impact of what the rate does. So paying a $477 a month gives you your $27,000. Bumping this up by, look here, guys, that's what, 30 something dollars, $30 a month is going to cut your 155 down to the 84, and then bumping it up to $300. So what is that, around 60 bucks? You will pay it off in 5 years. This is the impact that you find, that you really see when it comes to the APR of these credit cards. As you can see, guys, it is absolute craziness how much people pay. Now you think that's on a $10,000 balance. Think of the $1.03 trillion in credit card debt that Americans have right now. Rate could be a little higher, rate could be a little lower. But again, that 28% is the average of credit cards, and the tab is still running, guys. On this channel, I make videos about budgeting, financing, credit cards, making money, and financial literacy in general, because I know I can educate people to help them become financially free. If you like the content that I provide, please consider subscribing to the channel. Number two, we look at the fixed and the variable rates. Now, that is true. There are credit cards and credit unions do offer them that have a fixed rate, meaning that as interest rates continue to increase, like we've seen in almost the last 2 years, your rate on your card will not increase. They have some of the lowest rates that I have ever seen on cards. We've seen some that are 9%, 10%, 11%, 12%. That is about on average with what we have with our credit unions, which is definitely the way to get that fixed rate, guys. That is not going to change. Now we know with a lot of variable rates, last year the rates were 26%. This year they went up to 28%. Even in prior years, they were 18, 19, 20, kind of edging. As we've seen, again, interest go up in the last 2 years. The average nationwide is 28%, which again is kind of crazy when you could really shop around, find a card that has a fixed rate, do a balance transfer to that fixed rate, and then save an exorbitant amount of money as you repay that debt. Number three, we look at the introductory APRs. Now, this is really the hook that people get sunk into, guys. A lot of places will do 0%, even though most people cannot find 0%, even with perfect credit right now, because again, the average rate is 28%. So guess what the credit card companies realize? They don't have to offer the 0%. People will still buy the product and service. People will still pay the rent, balance transfer to those cards. You have to be aware and you have to be very cognizant of the intro APR and the intro offers that people have. So we have seen this with Art Van, which is no longer in business, but we've seen it with Gardner White. We've seen it with Best Buy. There's a lot of companies that will offer a 0% APR for the first 12 months, 24 months, 36 months, depending on what the purchase is. At the end of that term, if The balance is not paid in full. You are responsible for all of the interest accumulated on that loan from day one, guys. So we have seen members that have come in, borrowed $15,000 from Art Van when they were here, went through 36 months of 0% interest, got to the end, they were tacking on almost $10,000 of interest because the card was not paid in full, or the loan, whatever you want to call it, was not paid in full that they had through Art Van. So we actually had to do a personal loan to pay off the Art Van loan so they weren't charged an additional $10,000 because that intro 0% APR was expiring. Number 4, we look at credit card tiers. Now, some of the credit cards do have tiers based on credit worthiness. So if you're an A plus credit, you're in an A tier, you're going to get a good rate. Might be, an 18%, which honestly is pretty good for the credit cards. If you have damaged credit, if you have a poor credit score, C, D, and E, possibly looking at a 32, 36% rate, which is kind of crazy. I believe the government still does in a lot of places, caps the rate at 36% due to predatory lending guidelines, which again is kind of crazy. Now, in addition, guys, a lot of cards do charge a penalty APR if you are behind, if you miss a payment. A lot of them are even triggered by 1 day, meaning that if your card is sitting at, let's say, 22%, you miss your payment by 1 day, all of a sudden your card is at 30%. It will remain at 30%. It is super important and crucial that you are not late with the minimum payments on the credit cards, because most of them do have a very, very high penalty APR. Now, with that, guys, we also talk about the balance transfers and the rates. A lot of cards do offer, again, the special balance transfer rates, 0%. Some of them will also give you an incentive to balance transfer. What you have to be really careful about is there are many cards with balance transfers that do charge you an upfront rate or an upfront charge. We've seen this 3%, 5%, 7% for some of these cards. So if you're balancing $10,000, they're going to charge you 5% day one to give you the 0% over the next 12 months. Really have to break down the math and see it is worth it, if it really is what you think it is, and how long is it going to take you at that 0% to recoup what you're paying for that 5% fee. Now, again, this is really important when you're doing balance transfers to balance transfers, is that you're paying down the balance. A lot of people will balance transfer for months, even years on end. At that point, the original balance is not getting paid back, and the original balance is not getting paid down in its entirety. And they're just literally carrying balances for decades because they are never budgeting properly, and they're never, saving more than they spend, or have a good debt repayment program to where they're going to pay this card off. Also, with that, there are cash advance rates. Most of the cash advance rates will be extraordinarily high when it comes to relationship of the cards. Some of them also have a percentage when they do the cash advance, and a percentage which is much higher than your regular purchase rate. So you have to be super careful and know all the terms when it comes to cash advances on your scores. Now, as we look at that, guys, number 8, we get into the credit score and the impact on the rates. If you qualify for a credit score, as we know from the utilization of the credit card, if you're starting to use more of that card, chances are your credit score is going down. A lot of times this can impact your ability to get loans in the future because of the balances that you are carrying on those cards. Number 9, we get into the credit card comparison. It is super important, guys, to compare credit cards. It is essential when it comes to rate, when it comes to terms, when it comes to rewards. Compare, understand the differences between the cards. Make sure you're getting the best card that fits exactly what you're looking for. And the final one is the interest calculation method, guys. You have to be aware of this. Do your research again before you get a card. Most people will just sign up for store cards, will sign up for any cards that they see having a very unusual place. We've seen some that have average daily balance. So depending on what the balance is what you're going to be calculated on. So during the month when you're accumulating a balance, there's going to be interest charged to that card because boom, they are looking at the daily balance that you do have on that card. Some of them also do it per month. So again, being very cognizant of what you do and how they calculate the interest that is on that card. Guys, you have to know your credit card. It is super important that you really follow the steps and you break it down and know what you're getting into before you start accumulating those high balances. That'll do it for the video, guys, and I'll catch you in the next one.